Before we continue this session, I want to add a closure note to the part 2. All these strategies take a learning curve to master. Hence, I would prefer you do paper trades for a couple of weeks before placing order in actual market. Along with making an entry, mastering when not to enter the trades under a strategy also matters. Hence, practice before you place your trades in actual market. It will only do good to you. Also, if you can fine tune these trade strategies with a strategy or a price behavior you noted, it will give you added advantage in that situation. Coming back to this session, in this session we are going to detail a strategy called expiry day. Expiry trades on buy side are very risky. I would say it carries nearly 100% risk on capital, especially if you are trading current expiry options on buy side on expiry day. Now coming back to the other side, this can be extremely rewarding if you are able to find a good trade. 100% risk on capital also implies that there is a possibility of a handsome reward as well. Now, this strategy is all about finding a balance, which means more than the actual trade, this strategy is all about not entering the market as well. Also, it requires a good amount of effort from your end as well. When to apply? This strategy can be applied on expiry day, which usually falls on a Thursday. This can be applied as long as the expiry settlement is not moved to Friday morning. This update can be expected in coming years in Indian derivative market as well. The type of market it yields better results are directional trending market, which means in flat or sideways market, this strategy should not be applied. This is a very important decision to take as it involves not trading at all under this strategy. The more you are able to identify a flat or sideways market, the less you are likely to make a bad decision. Time. There is no specific hour in this strategy as it requires a whole day to find the exact entry. Considering the previous expiries, it tends to fall closer to 11 am and then closer to 1:30 pm. But speaking from the patterns in this behavior, it requires constant analysis with attention to minute details. In fact, the early stages of this setup starts from Wednesday after closing itself. Now let's talk about the process. Step 1. Note down the spot value of the Banknifty index on Wednesday closing, the day before expiry. List down all the strike within a range of 500 points, both on the call side and put side, which means 500 points up from the spot and 500 points down from the spot. You should fill this information in a table, and the table should contain the following information: strike, option type, last traded price on Wednesday, expiry day opening price, open interest on Wednesday closing, open interest at 9:15 a.m. And you have to update this open interest every 5 minutes till 3 p.m. You can get open interest data within 1 to 3 minute interval from NSE website, or you can use other private data feeds offered online. For example, if the spot Bank Nifty closed at 38600 on a Wednesday, then the table will look like this at 9:20 a.m. on expiry day. Here on we have the strikes 38500, and you can see that 38400, 38300, 38200, 38100 is here. And also on the upside we have 38600, 38700, 38800, 38900, and 39000 is there. And all these are on the call side. Like this we are also filling up the data for the put option side as well. And other data are, as we already explained, option type will be there, last traded price will be there, expiry day opening price will be there, open interest on Wednesday closing will be there, and open interest of that particular strike at 9:15 a.m. will be mentioned here. And it will this value will be we will keep on updating for every 5 minutes till 3 p.m. Step 3. For this analysis step, you need to have a basic knowledge about open interest Q reading in option. An explanatory read on this will be useful. While reading, it is to be understood that open interest in option buy side behaves different to futures. Hence, you can take the opposite view of the open interest behaviors in futures for option on buy side, and you can align your views on open interest behaviors in futures with option sell side. You should look for certain open interest behaviors, and it will be explained in step 4. Step 4, we must specifically look for open interest behaviors as such shows the following behavior. Scenario 1 usually happens in downtrending market, increasing open interest behavior in call side, decreasing open interest behavior in put side. Scenario 2 usually happens in uptrending market, increasing open interest behavior in put side and decreasing open interest behavior in call side. Scenario 3, flat market, increasing open interest behavior in call side, increasing open interest behavior in put side. Scenario 4, directional volatile market, impending decision from authority, like from government, decreasing open interest behavior on call side and decreasing open interest behavior in put side. Our further trade decisions will be based on the scenario we are in. Step 5, once you bifurcate specific market scenario, this strategy can be applied on scenario 1 and 2. In all other scenario, this strategy would not give results. Hence, applying it is not recommended in those scenarios. Now, as soon as you see this behavior in scenario 1 and 2, for 4 consecutive open interest updates, apply the following equation. If the scenario is 1, find the put strike closer to spot, let's call it A. Find the last traded price of A. Find the confident travel level for the index equals strike price of A minus last traded price of A. Then finding the put strike where open interest is still increasing, let's call it B, and find the last traded price of B and find the confident target for the index for the trade exit equals strike price of the B minus last traded price of B. For example, the spot is 38538. 38500 PE can be considered the nearest put strike, which is I previously mentioned as A. Find the last trade price of 38500 PE. Let's assume it is 250. Let's find the confident travel for the index equals 38500 minus 250 equals 38250. And let's assume 38300 PE open interest is still increasing and its last traded price is 85. Then let's find the confident target for the index equals, that is exit level, 38300 minus 85, 38215. This whole idea will take a couple of minutes to sink in, so you can take a screenshot of this slide and keep reading it, and eventually it will make sense. In scenario 2, we can apply the equation, find the call strike closer to spot, let's call it A, find the last traded price of the A and find the confident travel for the index with strike price of A plus last traded price of A. Then find the call strike where the open interest is still increasing, let's call that strike B. Find the last traded price of B, find the confident target for the index for trade exit equals strike price of the B plus last traded price of B. For example, if the spot is 38538, 38500 can be considered as the nearest call strike, that is A. Find the LTP of 38500 CE. Let's assume it's 250. Let's find the confident travel for the index 38500 plus 250, that is equal 38750. Let's assume the 38800 CE open interest is still increasing and its LTP is 85. Find the confident target for the index exit by following this simple equation 38300 plus 85. um, Take a screenshot and you can keep reading it to make a good sense of it. Now, as a closer note, you can place your trade as soon as the behavior is confirmed with 4 to 6 consecutive open interest Q in the table. Along with, you can use other directional cues which you are using it with your own analysis. In scenario 1, you can check where call strike, where open interest is increasing and tops. It can act as the most rewarding resistance. In same way, in scenario 2, you can check where the put strike, where the open interest is increasing and tops. It can act as the most rewarding support. The most rewarding support and resistance means where the market tend to behave as expected. From support, it tends to go up. From resistance, it tends to go down. You can use these support and resistance as a target to exit. You should not keep your position for longer period of time in options.